Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending on March 12th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is supply versus demand. Let's take a look at where the markets were this past week. It was really a relatively strong week, just about all across the board. That would be pretty much internationally. If we take a look at the index performance for this week, you'll see that just about everybody everybody actually finished in the green this week. The Dow led the way. It was up almost every day this week. It was up 4.07%. And the Dow pretty much jumped into the lead year to date, with the exception of the Russell. The RUT is up 10.89% for the week. You can see the best performing sector this week was materials, up a strong 10%. A lot in the materials is commodities. Worst performing sector, communications. It was down. It wasn't down 5.19. It was about 32 basis points down, 32 basis points. That was about it. But year to date, you can see energy still leading the way at 36.36% up. Staples leading the way down, or it took over the lead to the downside, 6.91%. Now, if we take a look at this and just kind of see what's kind of going around here, most of the index did, as I said, finish up, but we had 1.9 trillion get injected into the economy this past week when the Biden administration signed into the deal, the stimulus package. Now, I think that's about double what's really needed, to be honest with you. The government's already spent $5 trillion in the economy, but we're not going to get the ramifications for this for at least another year or two, but there will be some blowback on it. Needless to say, most economists expect this latest round of stimulus and the money that came into it to generate the fastest GDP growth in the U.S. since 1983. Looking for about a 5+ GDP growth this year in 2021. It's probably may even be a little bit more than 5, maybe 6 or 7%. We're going to see how this thing shapes itself out. Of course, looking at the economic data, and then we'll jump into U.S. Treasury. U.S. Treasuries. From the economic standpoint, we did get initial jobless claims this past week. It fell to 712,000. That's the lowest level since November of last year. Still above the highest level reached during the Great Recession of 07 and through 09, but still coming down. Continuing claims fell to about 4.1 million. Okay, again, it was below expectations and the lowest level for the year. I would expect these to continue to drop. So the healing labor market, seemed to be reflected also in this past week's University of Michigan's gauge of consumer sentiment. It rose a little bit more than expected. It hit a new post-pandemic high of 83. That was up from a low of 73.5 last April, but still well below the pre-pandemic levels of 101 this February of 2020. And then looking at U.S. Treasuries, bond yields clearly are pressured higher. Prices of bonds, as a reminder, fall, hence rates move up. The 10-year benchmark started the year under 1%. Now it's trading over, as you can see on the screen there, it's up 1.554%. So a pretty good little move there on the 10-year. And expectations are for, as I said earlier, with GDP growth, economic recovery, we should expect inflation in the coming months and years. Although Boom Boom Powell seems to believe that everything is going to be soft, I'm waiting for him to use the word transitory. That'll be my clue that we're going to get a faster bout of inflation. But remember what I said earlier, the week's theme is supply versus demand. And because of the trillions of dollars being spent by the U.S. Fed government, or the feds, through the government, really, during this pandemic, they're issuing debt, which would be the Treasury bonds, at a huge breakneck pace. I mean, it's just unbelievable. And if you guys remember your Econ 101 in college, or economics in high school, if you did take it, anytime supplies go up very quickly, prices tend to fall because there's more of it for sale. So that follows that all this new supply of 2-year through the 30-year Treasury bonds, which goes through the auctions every week or every other week, is on pace to reach about 3 trillion this year, and that's up from 1.7 trillion in 2020 and only 990 billion in 2019. So all of these trillions of dollars in treasury bonds and notes and T-bills needs to be purchased. Now the Feds, they've committed to a specific purchase run rate, but their purchasing of the net amount, meaning as the gross amount goes up, the Feds aren't purchasing more. It's going to leave the market with excess supply. Now, let's just see how much demand there is for this excess supply of US Treasury. We did have a burp in the auction market about a week and a half ago. If you guys remember, the S&P was down over 110 points. I think it finished down about 85 or 90 points during a bad Treasury auction of the 7-year. So the Fed's at that constant purchase level, but now that there's more out there, more supply, we need to see other countries, sovereign and hedge funds and banks pick up that excess supply. If they don't do that, or they do it, but they're going to demand a higher interest rate for buying those treasuries, then we're going to see interest rates go higher. Okay, it's just the law of supply and demand. So we've introduced triple the amount of supply, almost 2.5 to 3 times more supply in 2021 versus 2020. We'll see who soaks up all that extra supply. That's why I think interest rates are probably going to go higher over the near term or over the far term. I think they're definitely going higher. Near term, we can get some chop, but that's what I believe happening here. Okay. If we take a look at the European markets, let's just take a look at how it performed pretty much for the rest of the global markets. You can see the Euro stocks of the 50 largest companies in Europe had a very strong week, finished up 4.46%. Year to date, 7.9%. So really good. If you look at everybody else all over Europe, all in the green. And then over in the Asia Pacific area, Japan did really well. They were up almost 3%. Year to date, they're up 8.28%. China this past week and Hang Seng both came in the red. Year to date, China moved into the red for the year. And Hang Seng, which is a Hong Kong index, is still in the green, but much lower than where they were. So you can look at the year-to-date performance of all the major economies. The Russell here in the U.S. is leading the way at 10.89, and then coming in right behind it is the French market, the CAC 40 at 8.92. And so just really a lot of strength coming in this past week. Now, if we focus finally on the Chinese markets, they posted, as I said, a weekly loss. You can see there they came down for the week. And we saw net inflows into the Chinese stock market turn neutral for the first time since last November. Okay. This past Thursday, China concluded its annual National People's Congress. And if you've ever noticed, socialist and communist countries call everything, they put people in the name of everything. And the people have nothing to do with it. It's socialist or communist, the People's Bank, the People's this, the People's Bank of China. When I was down in Cuba, everything had the word people in it. And I had to laugh when the Democrats came out with a new bill and they had the word people in it. I had to laugh because people have nothing to do with it. It's all for show, glory, and money to line their own pockets. And that would be the communists as well. So this past Thursday, China concluded its annual National People's Congress. And this is what basically they're the highest profile political gathering of basically 400 really old political dudes in China. Yeah, there are a few women, but mostly men in this Congress. And they still do what Xi says. He's kind of the leader of it. And they came out, that's where they set economic targets and other economic policy for 5 years out in time. And they basically said that the Chinese 2021 GDP's target growth rate 6%. So we'll see. They generally will do everything to hit that number. Also, we saw in China this past week, their last month, that would be February's increase in the PPI, Producer Price Index, which is basically a measure of inflation at the manufacturing level, really increased. it increased there, and it shows that they're meeting demand in Europe and the US, and that is followed closely by a lot of international soothsayers, because when that grows, it kind of filters its way and they export inflationary tendencies over to the US and European markets. So I do believe inflation is going to be coming in here pretty good. All right. And that's kind of what we're going to see here. What I'm going to do is I'm going to take you over to some charts. Let me switch you over to the 4-year first. I'm sorry, the 4-hour. Let's just get this over here like this. It is the S&P E-mini futures chart using the 4-hour time frame. It's a really good time frame. I call it the X-ray view of the markets, right? It gives you a better view than say the daily. You can see turns a little bit quicker than you can see elsewhere. So if you look at the chart, you can see here where this downsloping channel here, we were in the uh, uh, every rally should be was I was having our members sell off on the rallies because we had all these bull traps in here, and you know the bias, the polarity of the market shifted to this down channel, and I was calling for a 10 to a 15% pullback. We got about 12% in Nasdaq, but we only got about 6% in the S&P. You can see here, just to the left of the 2020 closing price, this blue line here at 37.48.75, we actually went into the red for the year no earlier than about the March 5th. I mean, we actually were in the red intraday on March 5th. All right, so that was only a little bit over a week and a half ago, maybe not quite that. We were in the red, and then we've just had this huge impulse move up, moved outside the channel, broke it. We did a retest of the channel about 4 bars later. That was a little bit about a day and a half later. This is a futures market, so each bar does not represent a day. Each bar represents a 4-hour period. And on the futures chart, because it trades at night, it was about a day and a half later. We did a retest of the downsloping channel, and then boom, we took off. We also cleared a key prior pivot high over here, this B leg, Elliott B way up, right? We cleared it, but then it was a failed breakout. So now we're going to attempt it again. This has always been my key pivot point right here. And if we take that out, then 39, 59, 25 is going to be an easy run. You can actually see here, if I blow it up, we missed making new all-time highs by just a few ticks, right? I mean, if you look at this, you can see the tick on this actually hit 39, 58, 50. 59 and a quarter would have given us all-time highs. So for all practical purposes, we came back up and pretty much hit this prior pivot high here at all-time highs. Okay, now you can see my target here is a little bit over 4,000. I believe we're going to hit that, but not without a lot of agita, you know. But I've told our members back in December, we can expect a 10 to 15% pullback in the markets. We only got 6 in the S&P, as I said. So with all the money and liquidity being poured in near term, I do believe the risk of the higher move is an upside move, not a downside move near term. Okay. Now this is on the S&P. NASDAQ tends to get hurt a little bit more with rising interest rates because you're paying, if you run a discounted cash flow model on the future cash flow streams of technology with higher valuations, then as the interest rates go higher, it reduces a good deal the cash flow based on you know, just what the cash is worth today versus what it's worth a year or two out in time. The higher the interest rates go, the harder it is to maintain a higher PE multiple. So you're seeing those growth stocks, primarily the tech stocks, pulling off a little bit, right? Now, if we come in here and we look at NASDAQ, let's just take a look at NASDAQ futures. I'm going to switch the screen over just a little bit, and let's just come over here. And let's look at the NASDAQ futures. Where is it? Oh, let me just move. I got to move it over. I got multiple screens over here, and I got to just move this over like this so I can get it out of the way here. So let me just move this, bounce it around. Let me get the screen up for you guys. Here we go, right here. So what you're going to see here, um, as I move things around, NASDAQ futures. All right, now NASDAQ futures, even though the markets finished up a little bit on Friday, the NASDAQ futures was down over 110 points. Now look at this chart right here. Okay, you can see here the closing price. This is the NASDAQ 100 futures. We'll look at the composite cash index in a minute. You can see here we're just barely above break even for the year on NASDAQ 100 futures, right? The big cap are getting hurt big time in technology. And we've been in the red year to date, and this is a daily chart now. We went into the red on March 3rd, and we finally pulled above it on March the 11th, this past week, okay, in the middle of the week. And then we pull back, or on Thursday, and then Friday we pull back, right? We still managed to finish up for the week, but we're still just barely hanging on. If we look at the cash composite index, right, we're a little bit better, right? Because this includes small and mid cap stocks as well. So the 100 is the one getting hit the hardest. And if we look at my FANG index, which is basically composed of Microsoft, Facebook, Apple, Netflix, Google, and Amazon, you can see here, just like the NASDAQ 100, we're in the green for the year, but just barely. That's the dividing line, that blue dashed line. Now that shaded zone there is a natural pivot level support for the FANG index. And you can see we're just barely in the green for the year. Our last high, all-time high for the FANG index was made on February 16th. And then we've just been selling off, okay? Now, the strongest performer is the Russell. If we look at the Russell futures, you can see here we made new all-time highs on Friday. And even on the dip, when we pull back, on that forecast I was pulling back, we still stayed in the green. Even on the dip in January, when we pull back in January, we broke into the green January 6th. And the low point for the Russell for this year was really just one day, and that was on the 4th of January. Otherwise, we've just been making new all-time highs in the Russell index. You can see these compression waves as we compress down and we move up, almost like waves in the ocean. Now, I will say that if this moves up, depending on where this goes, we are setting up for a bearish divergence play, which would mean another compression move down, right? I mean, we move up for generally each move is it starts coming up and then down about 20 days later. So we come down and then a move up again right in this level here about 20 days later, and then it moves down and then we move back up again. So we've got, you know, probably another week or another couple of weeks of sideways to upside movement if you're looking at the cycles of the market, before we get a little bit more of a pullback again as well. Okay. Now, of course, if we look at volatility, you can see with the VIX, we're still hanging above 20. This is the longest we've been above 20, I think, in several decades. It's just crazy. Ever since we went up last March for the pandemic, we've stayed above 20. And the markets still are a little bit concerned. And I think they're concerned not so much because the equities are moving higher, but because the bond market is selling off, interest rates are going higher, and there's fear of inflation. I don't know how Boom Boom Powell, that would be Jerome Power Ranger Boom Boom Powell, how in the hell he's going to come out and make a statement that we're going to stop or we're going to cut back on our quantitative easing every month. Remember, they're spending 120 billion every month. 80 billion of it, they are buyers of those U.S. Treasury. Remember, the Treasuries, there's 3 times the amount of volume or supply coming on the market to be bought by somebody to fund all of this stimulus and all this stuff coming out. The Feds have been a steady, fixed buyer at 80 billion a month. So who's going to buy the rest of it? And those folks that buy the rest of it, whether it's sovereign wealth funds, Japan, China, hedge funds, big money center banks, as they buy it, how much are they going to buy and what are they willing to pay for it, right? The feds can always come in and pay whatever to keep the interest rates down, but the other folks that come in to buy, they can say, hey, we want a higher price or we're not going to buy, and then, or a lower price. And by buying lower, that means they get a higher interest rate, right? The coupon rate on those notes, bonds, or bills. So we're going to see, and I think that is being shown here in the VIX, with the VIX staying high as it is until this thing sorts itself out. Okay. And let's just take a look at the bonds. Look at what the bonds did on Friday. That, folks, that's a hard candle. That's over two handles to the downside, right? Um, we're coming near the 2020 low, which was near the 2019 close, right? And you can just see now, for our members, those that took the trades that I was talking about, has made, a lot of members have made, or many members, because they've sent me emails, have sent me notes on this. I said every time it comes up to the 50 EMA, which is this red line, sell that sucker. This was what we call a low-hanging fruit trade. And for those you freebies that are watching this, I highly encourage you to come in. Just one of these trades alone, and you've covered yourself here with our group. But we do a lot of things here, and we do, especially in the commodity and the treasury markets, some of these trades are great low-hanging fruit trades. And we're going to get buys and sells of a lifetime with rates as the dynamics and the polarity of the market shifts. But you can see here this big sell-off down here like this, just away we go. And then let me show you the effect on the interest rates. I mean, I don't need to tell you the direction of this chart, do I? It's up, left lower hand corner of the screen to the right upper hand corner of the screen. The chart, you can just see away we go. And that's what it's done. Interest rates are going higher. There is no signal of a divergence here. It just shows huge strength coming into the market. Now, I think we're going to get into a chop and a little bit of a pullback. But again, if it pulls back and it gives us a gift, meaning it comes to this red line, which is the 50 EMA, you should be scooping up as much of this as you can, because it's just going to be the gift of a lifetime. Okay. So bonds, treasuries, there's others out there that we follow that can be good buys. Members, for our Sunday night session, I'll go through some more detail for you on that. Currencies, same way. Now, the US dollar is off the lows back over here. This was another low-hanging fruit trade, and we were way back over here shorting the dollar as it was coming down, or basically going long the euro. Okay, because it's really not the dollar. The dollar, it's called the dollar index, and it moves based on where other currencies go. The biggest holder, or the biggest mover of the dollar index, is the euro, which accounts for about 58%, 57.6, 58% of the dollar index. The yen accounts for just under 14%, and the pound about 12% of the dollar. And that's the big movers. Wherever they go, the dollar goes in the other direction, right? So we're getting this bounce off these lows, and you can see we made a 2021 high here and a little bit of a pullback. I still think the dollar is going to probably just fool a lot of people, because there's a ton of shorts in this market. It got very crowded once it started moving beyond my support level right here around 91.11. And it started getting very crowded down here. And when you get very crowded in a trade, it tends to go in the other direction. This chart here is going to suggest to me that the dollar is still going to go higher, which means probably some downward movement in interest rates, and commodities will level off just a little bit. But then if it does get up here and gives us a gift, you're going to want to short the dollar. By the same token, the euro is going to be just the opposite. Okay. If we look at the euro, remember over here, it was a low-hanging fruit trade. I was saying, guys, you got to be long the euro, right? And then boom, away we went. I think a further target for the euro that I have is up here around 126. It's at 119.5 now. I think the euro, as you can see by the projections of the Elliott waves, it's going to go a little bit lower. But I do believe over time, once it settles in, there's going to be some long trades in the euro. And that's the way you can play a short dollar, is just playing long the euro, because they kind of go like that. Okay. If we look at metals, well, let's look at gold for a second. It's just undone. As I said, once we came down and hit that support level, I said last Sunday it'll probably come up, test this level here. So if you wanted to go long gold, just a short-term swing trade or even a day trade, I think it's going to run up here and possibly get into this support zone here, or this resistance zone rather, and find resistance at this downsloping trend line. And then if it breaks, that means we're going to be neutral to chop for a little bit of time. Okay. And that's gold. Silver is a little bit more bullish than gold. Okay. You can see we're outside the downsloping channel, but we're in a sideways chop. All right. It's just a not tradable instrument at this point in time, unless you want to day trade it. Okay. And then, of course, if we come down and look at oil, as I said, and I told our members, you want to fade this move up here. So just do some bear call spreads, bear put spreads, fade this move up in this area to come back down, settle down in this area a little bit and gather a little bit of steam. I think we're going to have a little bit of a fade off of this big move higher here. Okay. I don't see $70 barrel oil near term, but I do believe we're going to eventually work our way back up there. Okay. Nat gas, anytime nat gas gets high, as you guys recall, remember when it was up in this area here, I said you got to fade it. And here we go. We're already back down again. So again, that's a low hanging fruit trade. It's one of those kind of trades you just got to jump on and take. And then you're playing the probabilities of the market and where it's going to go. Okay. So these are just some of the good trades. And then, of course, gasoline, another low hanging fruit trade, guys. Look at that chart, left to right. Let's get rid of this right here. Let's get it back off the screen. So looking at that chart, left to right, there is no doubt in my mind, and I just keep every day I look at this, I have to raise it up, making new 2021 highs. This is a low hanging fruit trade, guys. I mean, that is where you want to be in the futures market. It's just, that's a home run. Now, if you can't trade that, then just as a little Benny, you can trade UGA, Uniform Golf Apple. It's a stock ETF. It's cheap too. Back over in this area here, right when um, once we knew that the unaccompanied minor we call Biden got into office, then this was one of my calls. I said, you got to be long gas, you got to be long oil, gasoline. You got to come in here at $20 a share and picked it up. It's already sitting at $34 a share. So that's, that's more than the 65% move off these lows down here. These are low hanging fruit trades that our group loves. I love to find in the commodity markets because we're just playing whoever's in office, right? Regardless of your political persuasion, we want to make money on whoever or whatever knucklehead's in office. In this case, it's a big one. So there's going to be some opportunities made with all that money flowing into the markets. All right, everybody. That's pretty much my view for today. Remember, tomorrow, for most of those of you watching this in the Americas, move your clocks forward 1 hour. It's my favorite time of the year, daylight savings time, where you can get out and play around or go to the beach. Down here in southern Florida, which is where I am, it's beach weather today, tomorrow, and all next week. So, and spring break is just wrapping up. So all the young teenage knuckleheads are leaving. So that's a good thing, right? Things will calm down just a bit. All right, everybody, have a really great weekend. Daylight savings time, Sunday morning, 2 a.m. For most of you here in the U.S., over in Europe, I think it comes in the end of March. Have a great one, everybody. Members, I'll see you Sunday night for our weekly market watch. Take care, folks. Ciao.